All right. Well, good afternoon, everyone. I hope everyone is keeping warm. I apologize first and foremost. My intro summary. I think I need to update that. It's been a while. It's at 15 years. I think we're gone on 18 years now. I was joking with Patrick that my picture was me like 6 years ago with like less tax seasons in me, less wrinkles, and so that's on my to-do list. And this is my business partner, Miguel Fierro. And Miguel Fierro as well, I'm going to post it up here. Miguel Fierro, he's the owner-operator of ATAC South Denver, and he has his bachelor's in accounting from Regis University, and he has just as long doing taxes as I do. So we have over 34 years of experience here in Colorado serving our Denver community, Metro Denver community. I'm transitioning over into the growth director for ATAX in Colorado. I am a CPA. I still have a CPA. I call the CPA, the acronym is Can't Pass Again, so I don't know if I could take it and do it again. The laws have been changing, but we love what we do, and we specialize in tax, and we specialize in small business and medium business. So that's a little bit about us. I kind of had to put the little funny pictures up there. We had a little backpack drive. This year we give free backpacks in our ATAX locations to kids, that need it with school supplies. And that happens usually in August, and it's a great event. Families love it in our community, and so forth. And Miguel, we have him there giving away some Christmas presents to his clients. Yeah, so we're gonna go over the inevitable business owners and taxes. We're all wanting to be business owners or are business owners. Raise your hands who are business owners now. Everybody, right? And who wants to be a business owner? I think everyone's a business owner, so that's good. Welcome. Thank you for coming, bearing the cold, and we'll get to it. We'll leave some time for Q&A at the end. There's always, every slide can lead us into a rabbit hole, into multiple questions. One slide will say, hey, well, I think I need to, emphasize on my questions on that, but we're here to, and we're available to help, and we left our business cards out there as well. These slides, this presentation pertains basically to everybody, whether you're in real estate, whether you're in sales, whether you're in research, scientific research and development, almost any industry, really. There's still the fundamental basis on what we do. I kind of wanted to bring up my postman that he visits me all the time. His name's Kevin. He retired this year, actually, like last week, and I just remembered him. And he would come in and give me a quote every year during tax season, Romans 13. And it's, this is also why you pay taxes, for the authorities are God's servants who give their full time to governing. Give to everyone what you owe them. If you owe taxes, pay taxes. If revenue, then revenue. If respect, then respect. If honor, then honor. So it kind of felt home, right? Because, we feel like we're doing our service and making sure that our clients are represented in a way that we're following the tax law, paying our taxes, but we also paying the right set of amount, or the right amount of taxes. Everyone has a different interpretation of that, but there's different ways in paying your taxes, and I'll go over some slides. I have a nice funny one as well. I like to keep it kind of comedic, because taxes are boring, right? So we try to make it as fun as possible. So we're going to start. We have a little agenda. Obviously, introductions. We'll start with choice of entity. I think we had some people discuss about, right, S-corps.
Yeah, we have some S-corps and some sole proprietors.
Any C-corps in the house? No? Okay. Well, it's good to know. And then basically what leads once you start going. The beauty about the United States is you can open a company. It takes you 15 minutes to open a company. I opened a company in Mexico. It took me 6 months to open a company in Mexico, going through all the legalities and everything. So here we can get going tomorrow and start your American dream, which leads into administrative things like, what am I allowed to deduct? Some of us that are freelancers, one of our biggest deductions that we wanted to emphasize will be the vehicle deduction and the ins and outs of that. You know, anybody with the W-2, when you go do your taxes, have you ever heard your tax preparer ask you about your vehicle as a W-2? Probably not, because the W-2 you can't really expense anything. Up until 2017, you were allowed to take unemployed employee reimbursement expenses, but you can't take those anymore. So the laws are favoring more freelance entrepreneurs, business people. And then obviously we'll talk of business structure, and as you scale, you know, pay. What we want to do is pay a lower tax, pay Caesar what he's due, but earn in a higher tax bracket according to what the rules are, you know, and then final tips and takeaways. So I'm going to let Miguel get started. There's a picture of him again. Miguel from ATAX South Denver.
Right on. Welcome, everybody. So, choice of entity. The first one we have, it's an LLC, right? So you see that a lot in the company names, you know, LLC. What that means, it's limited liability company. And that entity, all it does, it protects you legally, but that's it. With the IRS, you're one and only. You're a single member. It doesn't mean anything that you're an LLC. So there's always a lot of confusion when people start LLCs and they come into our office and they say, oh, I'm an LLC. Okay, what kind of structure do you have? I don't know what that is. Or I don't know, like I have a company. So it is always very important to differentiate what taxes means and what legality means, right? So what an LLC does, it protects you legally. It keeps the responsibility and the liability within the company, as long as you don't intermingle personal and business expenses, right? As long as you keep them separate. If there is a lawsuit or something going on legally, it will protect you and it will only stay within the business or personal, right? So that's what LLC does. And then the next structure we have is corporations. So corporations are technically its own entity. You know, once we create a corporation, it's its own thing. It manages its own finances. It's nothing personal. It's all within the company, right? You keep the money. It belongs to the company. It doesn't belong to you. So if it's a corporation, everything stays there. So if you want to pull money out, it all depends on your structure and how, you know, if you have a salary, if you have, if you're an S corp distribution, or if you're a C corp, you might do like a dividend payout.
Same thing goes for nonprofits. Nonprofits are its own entity, lives by itself. Most nonprofits you'll open as a nonprofit corporation. You know, same structure, same premise.
So again, we have sole proprietors, a single member LLC. For tax purposes, it doesn't mean anything. It's just that you have a company, but when you file your taxes, it goes under your personal return, right? When you have a corporation, the corporation files its own taxes. And then it depends on if it's an S corp or a C corp, then it passes through to you, or it stays within the corporation, and then you file your own. But when you're a single member LLC, it's just your taxes. The IRS says, all right, Miguel, you're a single member LLC. Well, you file your own taxes. You're a Schedule C, and that's all you are, right? Then you have deductions, but then you don't have a lot of tax savings there. And then we have the famous S corp. I know we have a few, but what it does, it's kind of like a hybrid between a C corp and an LLC or a single member. So some of the deductions that the S corp might have, they go through you at the personal level. Let's say health insurance, it's one. Meals and entertainment, charitable donations. So if the S corp does those, they pass through to you, and then you have to report them in your personal tax return. But then the S corp is actually very popular right now because it saves you on the self-employment tax. So if you're an LLC, single member, you file your own tax returns, one form, you have the self-employment tax, right? And that's 15.3%. So what the S corp does, it says, all right, let's restructure your company. We'll separate it from you. It's no longer going to be one and only, but we're going to have two. Then the company files its own taxes. Then whatever profits we have, they pass down through to you, and then you just save the self-employment tax. Questions? All right. So the only caveat with the S corp is that you have to have employees. You have to have payroll. The IRS says if I'm going to save you money in the self-employment tax, then I also need payroll tax to be paid to me, right? So if we have a single member LLC, you don't have a lot of rules to follow other than, your business, your expenses, your profit, you pay taxes. That's very simple. When you restructure your company and then you become either a C corp or an S corp, then at that point we have bylaws, board of directors. We have to do payroll. We have to keep the expenses separate. You can't do your personal. You can't use personal expenses because at that point you're intermingling expenses there. So, and you have to follow those rules. You have to have board meetings. Yes.
What's the tax rate on payroll taxes?
The tax rate? So on payroll taxes, you pay 15.3% as well, that's the rate. FICA is that, but the employer pays half, and then the employee pays the other half. So it's 7.6, right? But since you're your own employee through an S corp, so you will pay the full 15.3%. Your company will pay the portion, and then you as an employee will pay the other portion. Does that make sense?
So if your tax bracket's 20%, just on regular income, non-sweat, I call it non-sweat or sweat income. So sweat income is self-employment income. You're sweating to produce something, and they tack on 15% for you to sweat. So how do you structure it as you build your company and you start getting residuals from your fruits of your labor, working hard in sales, creating a sales team, your real estate team. Now it starts getting residuals. That's not sweating income anymore, right? It's it's the rate of, it's your investment return. So leaving it as a LLC, the IRS is really quick to classify it as sweat income and keep it at that self-employment rate. And that's why you always want to build your careers and your business eventually for one of two things: retire, sell it, make some money out of it, and give back to the church or to the kids. Or you had a question?
To that point, so if you had a company that was you own a property, you're renting it out, you weren't taking it in, you didn't have payroll or anything like that. You just letting the property pay for itself.
So that's not sweat income. That's investment income. So that's real estate.
What business structure should you have for something like that?
Legally, I mean, you can still have an S corp where you can have an LLC. A lot of people even do an LLC, make it an S corp. It still flows through your personal as a Schedule E, like investment income, rental real estate.
Strategy would it be better as an LLC?
On rental real estate, I'm going to say yes, unless you're doing a bed and breakfast. If you're running a hotel, like Airbnb with daily linen service, breakfast in the morning, things like
But
that.
if you're running as an Airbnb, but you're kind of like the sole employee, you're not taking the payment like you're the ones.
I would probably leave it as the LLC. What would you think, Miguel?
Well,
Rental.
What about when you're selling it? If you ever want to sell the property, I think it's a lot more difficult to do it through the LLC. Through the S corp, as if you keep it within an LLC just to protect it legally, but within your tax return, I think.
Did you say you have to have a W-2 for employees to have an S corp?
Yes.
So if it's just property,
I would not. I don't think you should put it in a rental property. You shouldn't put it into an S corp.
It still goes on a different form within the S corp. It goes on a rental real estate form. And then it passes into your personal as a rental real estate. So that one might be like that gray area where you might not need the payroll. because you might even be hiring a management company to. That's the sweating. The people that are sweating is the management company. So I agree with Miguel. I think the LLC is the best way, and it serves two things. We're not legal professionals; we're tax professionals, but it just crosses us all the time. I might disagree 8 out of 10 times with the lawyer, like on entity setup, because they're really focused on legal protections. We're focused on tax protections. You know, and sometimes they go together. Sometimes, most of the time, they don't go together because someone's going to tell you to create an LLC for every single little property, you know, and now you're running 10 LLCs for 10 different Airbnbs.
It makes tax time
And we make more money, but I mean, in reality, I would just say, man, you just could have put it in one, you know. But those are the conversations. It's a good problem to have.
So
but
think
great
about
question. Great question.
All right. So again, LLCs, legal protections only. Corporations, it's its own entity, and they have to follow the rules of the corporation, bylaws, board of directors, what the board of directors decides on what the future is, if they want to pay out dividends, if they're in the growth mode. And then S corps are kind of like a hybrid with requirements, right? Certain expenses, even though you're paying it through the S corp, they pass down through to you. And then some of them, the 3 that I mentioned, and then the other ones, they stay within the company, but you avoid the self-employment tax.
Which leads us into the next topic. You know, he's talking about expenses flowing through into our personal returns. So as of business owners, you know, tax deductions, they're pretty broad. You know, that's the nice part, is that we have that, you know, it has to have something that the IRS calls, or tax courts have ruled, economic substance. So whenever you're spending any money, what's the economic substance for your business for that expense? You know, so, you know, a trip to Tahiti, is what economic substance does it have for your engineering, you know, or scientific research? It might, you know, if we're researching something. As an accountant, it might not have any economic substance. It just depends on how you see it there. So when I tell my business owners, find economic substance first, and that gives us, you know, the business deduction. So, you know, best practices, you know, tax deductions as business owners, set up a business account. I think Ryan can help us out there. They got a great bank there at Solera, you know, so set up the business account. Make sure everything, best practice, runs into the business account and runs out of the business account. And take it firsthand. I have an Airbnb. I run my personal credit card, and I'm like, as a CPA, I'm running around trying to find my business expenses on my personal credit card. And I'm teaching people. I'm like, oh my God, I'm not doing what I'm supposed to be doing. And that's on, you know, just that small Airbnb that I have. And I'm trying to search for 4 expenses that I remember. So you end up losing the expense because you can't find it. And so best practice, open up a business account. They're relatively easy, you know, with the business documents from the first slide. Day-to-day stuff, you know, a lot of us use our cell phones now, right? We can't live without our cell phone. Can't do business without our cell phone and or our computer here to do this cell phone presentation. Dues and subscriptions that come along with this cell phone service, Zoom, PowerPoints, you know, what is it, Microsoft Office, you know, anything that relates, you know, as real estate agents, you guys have Metro List, RE Colorado, you know, there's really sophisticated software that you need to get, you know, this GoPro here. Basically anything in this room would probably be a business deduction if I were running a nonprofit or a for-profit company, down to even the food that we're serving today. So anything that has, I kind of have this like lock boxes, signage, business cards, you know, the advertising portion. You know, our realtors probably have lock boxes. Our Airbnb people have lock boxes, the locks. And then anything that we do, you know, marketing, social media, advertising, we like to structure gifts as advertising, because a gift flows into the personal level where that's no economic substance for the business. It's just because, you know, Paul wanted to give some money to somebody, then it's not deductible. But if Paul's business says, hey, put my label up, and, thank you for, sponsoring us, that's advertising. Because now you have an economic purpose for it. And and it's serving both things. You're helping the community and you're helping yourself on that deduction as well. So, FYI, I always say if you can try to structure it more on the marketing side, it benefits both parties. Because then there's the economic substance to there. Meals and travels, that's the biggest gray area. That's where the IRS hates you. But sometimes you need it. I mean, do we all travel? Everyone travels, right? Everything's interconnected. Ordinary and necessary. So how much to make, how do we make them both work for us, right? So if I go out and have a meeting with Miguel, for this presentation, I'm probably going to be able to deduct this meeting because our intention was for this event. If I go out to eat with them every day, most likely there's no business purpose. I just like the guy and, we want to go have lunch. So my goal is to make it as business purpose as much as I can to have a valid business deduction. Ordinary and necessary, obviously. Tips in the industry, in the trade. Some people might have more travel. Some people might have more meals. Like a real estate agent, a sales rep, you're meeting with people all the time. That's probably going to be very common in your line of work.
If I'm a real estate agent, can I deduct my dry cleaners because I have to look presentable?
I'm going to say maybe.
What do you guys think?
I couldn't hear the question. Anthony?
Dry cleaners for like lawyers and real estate agents.
And that's always like, we don't want to say yes or no ever. We want to understand the facts and circumstances, because we can make it deductible. What do you think?
Well, it depends.
Right?
Because the suit has your logo, and then obviously you can be all wrinkled up, but if it has your logo, then at that point, I think so. What's other instances or circumstances?
If you're a performing artist, you need to clean your stage, your costumes, right? So that dry cleaning is that's deductible. Makeup, if you're a performing artist, that's deductible. It's all based on facts and circumstances. So make your fact, in your circumstance, business deductible. People always tell me the travel part. Hey, I booked a trip with my family to Disney World. Can I deduct that? And I'm like, oh man, okay, so I'm going to give you the story, and then you tell me the story. The intention of the trip has to be business related first. So did I book my flight with my family before I booked my convention to Orlando? That's the facts and circumstances. I might have booked my trip to Vegas for Latino Tax Pro now. It's probably all deductible on my side if my wife and kids decide to join me. Their portion is not deductible, but mine is already deductible. So it just depends on how you label that. Any questions on just kind of basic day-to-day expenses? First and foremost, always back to that first bullet point. Make sure it runs through the bank account so your accountant can find it or your bookkeeper can find it. Yes?
What do you see as the big flags on these that get people audited?
I think frequency, type of industry. I've seen it where it's a large percentage, so then it falls into the category of, is it ordinary and necessary to produce the income? More on the travel and meals and travel side. Everything else on top, if there's a valid business deduction for it, you can take it. You have the receipt, And then I'll let Miguel kind of go over one of our biggest expenses that we have here. Go ahead.
Can you provide just a credit card statement for receipts, or do you have to have the physical receipt?
I advise my clients to always keep the physicals. Well, like scan them, take a picture of them, send them to an email where you only send those receipts, toss them. For us, we just need the credit card statement, but if you ever get audited, you have those receipts, those copies that you can supply. Because it all depends on the auditor if they want to take the credit card, because you might have an expense that, let's say it could be to Home Depot, but you bought like a gift card at Home Depot, and it was not lumber. So the auditor might say, how do I know that you actually purchased something that was business related at Home Depot and you didn't purchase a gift card? So they might want to see the receipt. So always save them. You don't have to keep it in a box. Now with technology, you can scan them, you can save them, take a picture, put them in an album, code them, like per year, and then just leave them there. But I advise that you always save them.
Patrick?
How long you gotta keep that stuff for? What's the general rule?
The IRS says about 3 to 5. I would say no more than 5 years.
Great questions. Great. That's awesome. So that leads us into one of our biggest deductions as business owners, whether you're, even an accountant or freelancer. It's our vehicle expense. So I'm going to let Miguel kind of go over the types of ways we can deduct our vehicles.
So this is a really good one, because this question always comes up in meetings, when we're prepping taxes or when we're doing tax planning. So when it comes to vehicle, we have either you go with the miles that you drove, or you go with the actual expenses that the vehicle incurred. So, and it all depends which one gives you the biggest write-off. So when it comes to miles, we have a rate that accounts for repairs, accounts for insurance, accounts for depreciation, accounts for gas. So if you're in the industry where you really have to drive around a lot, if you're a landscaper, for instance, you have to go, from this house to this house to this property to this other property. Well, at that point, it all depends what gives you the most, right? When we have actual expenses, sometimes it might give you the biggest write-off. If you have a very expensive repairs, the depreciation on the vehicle, and then gasoline, insurance, license and registration, all the different things. If you have to, make the vehicle, make modifications of the vehicle to make it fit or to carry, heavier stuff. It all depends on what you do with it. But those are the two different things that we have. Now with the miles, the mileage method, the IRS requests that you keep a log, right? You have to say, okay, I drove from this place to this place, and keep your miles there. Commuting miles. This is the question that always comes up. From your house to the first property you drove to, it's not deductible because we all have to commute, right? Somebody who works at McDonald's have to go to McDonald's, and they're not able to write it off. Now, so from your house to the first property, that's commuting. And then from the very last property back to your house, not deductible. Other than that, everything in between counts.
What if you charge reimbursement for mileage to your clients? Like you have to drive to their house and it's 70 miles and you charge them 70 cents a mile. Is that considered income or is that?
Well, no, because I don't think it's considered income. It becomes a.
Well, it's income.
Well,
and
it's
then
income.
an expense.
Yes.
It washes out.
It becomes their expense to them. But then on the same time, whatever you're gaining from them or whatever you're charging them, it's part of the whole income that you're getting. Questions?
Anybody drive their vehicle for their business? Oh, a lot of people, right?
So now we have apps that can actually do it for you. I have clients who actually do keep a log. They're old school. They really write it down, and I really love those clients. But now with technology, it makes it a lot easier. So download an app, activate the app when you're driving for work, and then that will keep track of all your miles for you. Then at the end of the year, they will give you a report, and then you can bring that over to us.
What's the app called?
There are so many. There's a lot of them.
I know QuickBooks has it on theirs. It's like an extra $2 a month or something. The one I like a lot is that Miles IQ.
Okay, yeah, that's a very popular one.
We usually tell our clients to go to Grease Monkey every December, because if you go from December to December, they're going to keep track of your miles. Don't change the mile on yourself. I know you're good at it, but I need that receipt. I need the proof. So that helps us out a lot.
So whatever the app costs, I think it's actually worth the price, because you don't have to worry about it. You can just get your log over to us. That's proof of everything, and then you're good. So very few people keeps an actual log. Whatever, write it down.
We'd like to have, we'd like to advise our clients to have a personal vehicle and a business vehicle, because then that way you can keep track of business expenses. If you kind of have that hybrid approach, just a little bit more work on your end to split the personal piece versus the business piece. And that, it's going to come from you. Hey, I drove, my Grease Monkey says I drove 30,000 miles this year. 12,000, I used 1,000 of it, taking my kids to baseball practice, and the other, 18 was business. Okay. Or do I have just my beat up Honda Civic, $3,000 Honda Civic for my personal, and then I have my Tesla for my for my business? You have every right to choose what you want to designate your business vehicle to be. It has to get you somewhere. And that's where we can talk about that actual expense method.
Go ahead.
Can we talk about the limits on depreciating a vehicle for business?
Yes. So depreciation, we're actually going away from the bonus depreciation, but if it's a 100% business vehicle, you can depreciate it. Now, the method is, it depends on what current laws that we have. But if there's nothing going on, like I said, we used to have bonus depreciation when we could actually write it off on the first year when we first bought it. And then it went down to 80%, and then now we're at 60. It's probably going to go away eventually. But we also have other methods. But you can fully depreciate it. It's just that you're going to have to you're going to recapture, or you're going to take the full depreciation over 5 years. Yes.
And if you continue to own the property after you've completed that 5 years of depreciation, what happens, if you drive it for another 10 years? If you're an escort, if you're a sole proprietor, single member LLC, it's probably best to go with the miles, because you can always take the miles, right? And then depreciation will only limit you to 5 years. But if you're an S corp, you cannot go with the miles. You have to go with actual expenses, and then you fully depreciate that vehicle. And even if you keep using it, once it's fully depreciated, no more depreciation. Just actual expenses on the vehicle. Another thing that happens is if you fully depreciate it and you sell it, at that point, whatever you sell it for is going to become income that we have to report. Yes.
Are car payments considered actual expenses?
No.
Well,
it depends.
Like the lease. Yeah. Depends.
So it depends. Let me explain it why. So if let's say you purchase a vehicle right now, you have a loan on it, right? And then it costs you $50,000. You will write it off. You will put the full amount on your tax return this year. And then you're already taking the full amount. So whatever payments you're making on it down the road are not expenses anymore, because you're already putting the full amount of the vehicle. So, because otherwise you'll be double dipping.
What if you bought the car 3 years ago and now you're just starting to use it for business again?
There are two treatments you can do there. You can, let's say you already own it 3 years ago, and then you're going to start using it for business. You can use the miles, and then as long as you use it 100% for business, or even 50%, but you just have to use 50% of the miles, right? If you're going to give it to your S corp or put it to the S corp, then at that point it says if you're selling it, and you're going to have to use the fair market value of the vehicle now, that's going to be the price point where you're going to start depreciating it.
What if you have an LLC?
If you have an LLC, for tax purposes, it doesn't mean anything, right? Because it's all just legal. It all depends on the structure that you have. If you're a single member LLC, then no structure, no S corp or well, corporations are separate, but no S corp, then it's miles. Probably mileage will give you
And the
better
key
deduction.
takeaway here is there's no yes or no answer.
Right.
We're it's how, what we can find in the tax circumstances. If we have a lease payment, right, or let's say we're an S corp, and usually we advise our S corps to purchase the vehicles, because then you get that depreciation, especially heavy vehicles, like heavy vehicles. The Ford F-150, the most sold automobile in the United States,
Right.
weighs like 6,057 pounds. Why does it weigh an extra 57 pounds? They just added another piece of steel underneath the bumper. But because of the rule, anything over 6,000, they let us take an extra, try to maximize that full 80% to 100% full deduction that first year. So if I made $100,000, that I'm going to give the IRS 40 because I'm an LLC because of my tax bracket. If I went and bought a Ford F-150 on December 30th for my business and paid $80,000 for it, what's my profit? Or what's my profit in my business? $20,000. I provided jobs to Michigan. I provided, the dealership. So it's stimulating the economy. It's not about saying, it's about reinvesting into, to your business to get that deduction. So heavy vehicles work really well. Mileage as an S corp, you can do mileage, but then you have to create what they call a cafeteria plan. So you got to resubmit an employee reimbursement for mileage, which is tax deductible for the business and tax free for the employee. But guess what? If you have 6 employees, you better reimburse all 6 employees. You can't just do it for the owner. So it gets a little bit trickier on that mile. So there's no wrong answer. It's just how we structure, like what the game plan is. But these are really popular deductions because, like you said, you have that payment, right? But they say you saved, $30,000 in taxes. That payment's not going to mean anything to us in 25, or 26, 27 because I already took the savings in 25. You'll take the interest. They'll let you deduct the interest. But we kind of got our benefit early. Because we don't know what the future's going to bring. Hopefully we do well next year as well. Then we buy another truck. I don't know. No, we'll figure it out. But that's where the planning comes in. That's great questions.
Any other questions?
So vehicles are, go ahead.
Yes.
I just want to point out that we get in that trap of buying a new vehicle saves us all this money, but we did shell out $8,000 for a new truck.
So the tax planning, right? If you shelled out $80,000, but you saved $32,000 in taxes, so did it really cost you 80?
It's cost you 50.
And you're still enjoying it, you're probably still driving it. Whereas if you're a W-2 employee, what's your deduction on the $80,000 car? Zero. So, this is why this is really important to kind of see it in that conceptual limelight, not stuff that we use on a daily basis that we don't get any benefit for. Running your own company actually changes that narrative. So we're going to move into that other final piece, paying taxes. Who do you think pays more taxes, the guy on top or the lady on the bottom?
I look like a Warren Buffett.
Yeah, that's Warren Buffett.
Oh, it's
right?
Warren Buffett. Okay.
Cartoon version. And we just put a real estate agent. I'm going to say, who do you think pays more taxes, Warren Buffett or the real estate agent?
You're talking about percentage or dollars?
Well, that's the question, right? Well, I asked the first question, who do you think pays more taxes? Probably Buffett,
Probably
right?
Buffett.
Because he makes so much money.
In terms of money,
In
yes.
terms of money, he pays a lot of taxes. But who pays the lower percentage? Probably Buffett too. So because he's structuring it, he's paying Caesar what's due to Caesar, but he's doing it on the non-sweat income route, the investment route. So we always want to invest in ourselves to create that investment income. So that leads into like the tax brackets when you talk about what am I doing? Tax rates for single payers, the not so fun slide. I call this the not so fun slide. So as an LLC, if you look at the LLC, that's the blue one. If you run a single member LLC, this includes the self-employment tax. You know, even just starting at 50,000, your tax bracket could be at 40%. I'd rather buy that truck if I'm an LLC. I don't want to, you know, I want to give it, you know, foster the economy. And you're probably averaging, you know, in the 40s, you know, all the way across, you know, as an LLC. But it's the easiest one to do, easiest one to get going. You know, you can start tomorrow, opening up an LLC tomorrow, start doing what you need to do. But as you see, as you start making more money, now you see the S Corp is, you know, if you're on the lower end, anything under 100,000, your effective rate's probably in the 20s.
But you're still paying payroll taxes.
But how much in payroll tax?
15%.
But how much of that is payroll tax? If you make $100,000, you owe 40 on the LLC, right? If you make $100,000 as an S corp and 30,000 of it is payroll, how much is the tax on the other 70? It averages out in the 20s. It's in the 20s. Because you have to have a payroll. You have to pay yourself a reasonable salary. What's that reasonable salary? Well, you know, that's what we talk about. If you want to pay yourself $100,000 of the $100,000 profit, then you're still going to be in that 40% tax bracket. If your reasonable salary is $30,000, then you pay 40 on the 30, and like 18 on the rest of the rest of it.
You can't use it though.
Well, no, as an S corp, you can distribute it. There's distributions.
How do you distribute it?
Transfer.
Just write yourself a check, put distribution. That's it.
So it's a distribution rather than payroll?
Well, you gotta have payroll on one end, and
I mean,
then
distribution rather than income?
And so the returns of the fruits of your labor as an investment in your company. So like, I'll give you a perfect example. If I'm a recording artist, right, and I get paid my W-2s to go perform and play, and I made some money there, but then I start getting royalties from my music, do I want to get W-2'd for my royalties? Probably not. I want to get that as the residual piece.
Well, what's the tax that you pay on the royalties?
Well, that would be the 20. That's the S corp.
20?
You know, whatever that rate is. So that's what we talk about the hybrid side. And then when you start making a lot more money, like I think a single taxpayer is about 200, and a married couple is like about 400. Then you actually start paying more taxes on the S corp, because your individual tax brackets go up as an individual. So this is where a lot of S corps start planning in terms of exit strategy or growth, start investing in their own company and trying to build it out for like the final, you know, payday or, you know, retirement or whatever. That's where that C corp, your tax bracket on the C corp, could actually be lower if you plan it correctly. Because if you're not taking money out of the company, do you want to pay the 40% tax as an S corp if you're throwing it back into the company all the time? You might want to stay in the 20s as a C corp, because your exit strategy is going to be the sale of the company versus always taking distributions out. So it just depends. I mean, there's no wrong answer. We just want to know, it's all based on facts and circumstances. Where are we in the course of our careers? Where do we want to go? And then what type of income you're generating. If you're generating sweat income, if you're generating investment income, you know, some of this stuff will not pertain to you. But, you know, that's kind of what we want to see, kind of give people, like, I'd rather earn money up here, but pay down here. So if I'm earning 40% income and I'm an S corp, I might end up investing in myself, starting like retirement plans and start setting money aside in investment accounts where the business can take the deduction on the retirement plan, like a 401k to myself as I build up my wealth. And then it keeps you in the 20s, you know. So
going back to the example of having a rental property, and if if you go to file your taxes in your LLC, do they just lump that in as like a personal?
Yeah, the personal Schedule C. There's a little box on the software that says, hey, is this rental an LLC? You just check the box. And then that's pretty much it, yeah.
And if you own a property that was your personal house and then you moved to another location and you didn't sell it, would you have to give the LLC permission to own that property, or would the LLC affect
A quick claim. But see, that one could be interesting because if it was your personal house, you still have about 3 years to figure out what you want to do. And this is, so a lawyer's going to tell you, LLC the thing, protect yourself. You know, you probably have enough insurance for that, if there's an injury or whatever. But there's tax favored rules. If you've lived in your house 2 out of the last 5 years, you can sell it capital gain free, up to $250,000 single, $500,000 married. Why would you want to transfer it into an LLC if that's still an option within those first 3 years that you ceased it to be a personal residence? So you still got year 3, year 4, year 5 to decide what you want to do with that house and avoid the capital gains.
So if let's say you're just renting it out and cash flowing, you leased it out for a year as your estate.
Yeah. You still got 2 years to figure out if you want to sell it or not.
So then the income on that would it be considered income of the LLC or personal income?
Both. So the LLC, like you said, doesn't matter for us as tax professionals. It's still going to hit you on the personal side. It's at a lower rate. It's not the 30. Rental real estate's not the 40%. It's the investment rate.
Yeah. It has to be clear too. You can't have a deed of trust on it. Otherwise, you got the due on transfer set clause.
Yeah, the lenders get involved as well when you do those quick claims into the LLC.
So you have to have no mortgage on it if you're going to put it in an LLC.
No mortgage.
Yeah, and that's the thing is that has nothing to do with taxes. It has everything to do with legality, lending, on that spectrum of things. But so that's basically where we kind of want to advise our clients. Where are we going? So I want to be on that C Corp route one day, in the front, and just work on figuring out how I can, get that tax rate on the right hand side. You start seeing it go down on the C Corp, and I think with the new legislation, I think S Corp, C Corps are actually going to be more favorable. We'll find out in the summertime, so we'll see what Congress decides to do. But I think that's.
She has a question.
Oh yeah.
What if you're an LLC for 3 months and then you're an S Corp for the remainder of the year? How do you pay taxes on
So when you elect to be an S Corp, you can select the day. So there's a window between January and March 15 of that year when you can elect to be treated as an S Corp.
For the whole
So
year.
So even if you start, let's say, I don't know, you open the LLC in May, and then you run it for 3 months, and then you want to be treated as an S Corp, you will elect that opening day in May to be retroactive to go back.
Great question. So you want to.
Final tips. So know your numbers, stay organized. So yes, so we talked about opening a bank account and keeping all expenses separate, right? Save your receipts, scan them, take a picture of them, keep clean records, don't intermingle personal with business. Those two can stay separated. Set your goals, know your business, know what you're doing, what are your goals, what do you want to do. You want to grow, you want to sell more, you want to, increase your revenue by a certain percentage. Know your business and then follow the rules, keep it clean. It's very easy, very simple. Sometimes you're in the store and then you have your business credit card and you forgot to pull the personal out. Be careful with those. Keep them separate, okay? Timing. So don't give your money away. There's always tax planning we can do. Like Enrique said, there's not right or wrong answer. It all depends on your circumstances and your structure and how we can help you get there, depending on where you're at, what's your income, how much money you're making.
set money aside now. We all got to pay taxes, and it's very hard when they come into our office and they're going to owe and they don't have anything put aside. So as you're making profit, as the money starts to come in, talk to your accountant, talk to us, let us know, hey, how am I going to look? How much should I put aside? Because next year I'm going to have to pay some of that, right? So save your money. Rural benefits those who follow it. Absolutely. So like Enrique said earlier, everything is designed to favor small business. A W-2 employee cannot write off a lot of things, nothing actually. So there are no write-offs. All they have is credits. Small businesses, self-employed individuals, that's a different story. There's a lot of different things we can do. So follow the rules, talk to us, let us know. We can help you.
One final question.
Yes.
Referencing your set money aside now.
Oh,
you didn't address
Enrique.
the quarterly 1099.
That goes hand in hand. You can pay the quarterlies. I have a real estate agent
I don't know what to do.
that earns 50% on his return. He's not going to give the IRS a single penny. So he'd rather just make his money and then pay it at the end. Just depends on who you are.
Well, you're penalized. If you're supposed to pay estimated taxes and you don't pay within, I think, 80% of the amount.
Yeah, they'll penalize you.
There's a penalty.
Yeah, so it's
You can't pay your
about
taxes,
2
right?
to 3% for the year.
How much?
Like 2 to 3%, depending on when you make the money. So if you made it early on,
Right,
you know.
right.
And like I said, my real estate client makes 50% return on that money. He's probably not going to want to give it to them, an interest-free loan to them early, or it's like 3%, 4%. Just depends on who you are, you know, in that category. A lot of people will pay the 80% and then not pay the rest because they don't have the penalty. You know, it just depends on, and that's when, you know, you want to keep it clean and talk to your CPA or your accountant to make sure they know where you're at. So those meetings are very valuable, August, September, October, because you kind of get an idea where you're going to be. And then you can go buy a vehicle, an $80,000 vehicle, or do what you need to do.
Or machinery.
Yeah.
It can be any asset.
Furnishings for the property, you know, give it a touch up if you have some extra disposable income.
When do you have to pay the 80% by?
It's actually factored in through every quarter. So she mentioned it's quarterly payments. So there's one in April already for next year. There's one in
So you
June.
pay 80% each quarter?
No, you pay 80% of what you owed the prior year.
No, but like, does it cut off at the end of December or?
Yeah, so
You're
some-
still paying taxes in April for last year, so.
So you would have two payments in April. One for last year, and then one for going forward for next year.
So you just have to pay 80% by April 15th?
No, 80%. So she mentioned you have to pay 80% of what you owed the prior year to avoid penalties. So let's say in 2023 I owed 8,000 or 10,000. So if I made estimated payments in 2024 of 8,000, doesn't matter within those 4 quarters, I'm gonna be okay. I don't get that extra penalty.
Okay, so
Yeah.
by January 15th, whether that lasts.
You'll probably make a 20% payment, so then you get the 40 to 60, 80 every quarter.
Okay.
Or pay it all. You know, not have to do it. But I think that's pretty much it. And then our emails are attached. We're located in ATAX, South Denver on Sheridan and Florida, up here South Denver. And yeah, we're here to help and answer any questions.
You guys, great presentation.
Thank you.
Thanks a lot.